March 2026. Update your money at risk. The Bank of England has just held their base rate. But with everything happening in the world right now, mortgage rates are creeping up and inflation is still biting. Whether you are paying off a mortgage, trying to build your savings, or dealing with credit card debt, the rules of the game have changed this March. But don't panic. In this video, I'm going to cut through the financial jargon. I will tell you exactly what this 75% base rate means for you. And more importantly, I'm going to give you the exact steps you need to take right now to protect your wealth. Let's get into it. Section 2, the context and latest update. First, let's quickly look at the facts as of today. March 2026. The Bank of England has decided to hold the base rate at 3%. So, why aren't they cutting it further? Well, inflation is currently sitting around 3%, which is still above their 2% target. Plus, with the recent geopolitical tensions and oil price shocks we've seen in the news this week, the bank is playing it very safe. Think of the base rate as the wholesale price of money. When it stays high, it remains expensive for high street banks to borrow money, and they pass that cost directly on to you. So, how does this actually change your life? And what should you do today? Section 3, mortgages and the cost of inaction. Let's start with your biggest expense, the mortgage. The average 2-year fix is creeping back up towards 4%, though you can still find deals around 7% if you look hard enough. Let's break this down into two groups. Group 1, tracker or standard variable rate mortgages. If you are on one of these, you are paying the absolute premium right now. Your monthly payments are directly tied to that 3.75% base rate. Group 2, the fixed rate mortgages. Listen closely. If your fixed term is ending in the next 6 months, you are standing on a ticking time bomb. Do not wait until your deal expires. In the UK, you can lock in a new mortgage rate up to 6 months in advance without paying an early repayment charge. Here is exactly why you must act now. A close friend of mine recently ignored their renewal letter because they were too busy. Their cheap 2% fixed deal expired, and they were automatically rolled onto their bank's standard variable rate at nearly 8%. Their monthly mortgage payment jumped by over £400 overnight. That is £400 taken straight out of their family budget, just because they didn't make a 5-minute phone call. By speaking to a mortgage broker today and locking in a rate early, you buy yourself peace of mind. If rates drop later, you can swap to the cheaper rate. If they go up, which they might, you've secured a financial shield. It's a win-win that keeps your hard-earned money in your pocket. Section 4, savers and the lazy tax. Now, let's flip the coin. High interest rates are actually a massive opportunity for savers. But high street banks are painfully slow at raising the interest they pay you. I call this the lazy tax. Right now, in March 2026, the best easy access accounts like Trading 212 or Chase are paying between 5% and 4%. If your money is sitting in an old current account paying 1%, you are literally losing money to inflation. Let me share a quick personal story. A few years ago, I kept my entire emergency fund in a high street bank paying a pathetic 0%, simply because I thought switching was too much hassle. When I finally spent exactly 10 minutes on my phone opening a high-yield account, I started making an extra £350 a year in interest. Think about that. Pound 350 of completely free money, just for moving digits from one screen to another. That's a free weekend getaway. Or your car insurance paid for the year. Check your banking app right now. If your savings rate doesn't start with a 4, you need to move your money today. And don't forget to use your cash ISA allowance before the tax year ends in April. Section 5, Bad Debt and the Escape Plan. Finally, we need to talk about personal debt. The average credit card interest rate in the UK is dangerously high right now. Often over 25% APR. If you have credit card debt, this must be your absolute financial priority. The best strategy right now is the 0% balance transfer card. This is where you shift your existing debt to a new card that charges 0% interest for a set period. Sometimes up to 24 months. I want to be completely transparent with you. In my 20s, I was stuck paying 24% APR on a credit card. I was making the minimum payments every month, but the balance barely went down. It felt like running on a treadmill and getting nowhere. It was incredibly stressful. When I finally learned about 0% balance transfers, everything changed. I moved my debt. And suddenly, every single pound I paid went towards clearing the actual balance, not making the bank richer. It completely removed my financial anxiety, and I cleared the debt a whole year faster than I thought possible. If you are feeling overwhelmed by debt right now, a 0% card is the lifeline you need to take back control. Section 6, Outro and Call to Action. So, let's recap your March 2026 action plan. Number 1, check your mortgage. If your fix is ending within 6 months, lock in a rate today to prevent a massive payment shock. Number 2, don't pay the lazy tax. Move your savings to an account paying at least 5% to get that free money. Number 3, attack bad debt using a 0% balance transfer card to stop the compounding trap. Economic changes are scary, but taking action is how you win. I'm curious. What is your biggest financial win or worry this month? Let me know down in the comments. I read every single one. If this video helped you, please hit that like button and subscribe so you don't miss the next vital financial update.
The quest for Fiesta Kingdom is long, but you don't struggle along. Subscribe and let's win the best together.